According to reporters, oil prices experienced a slight dip on Monday following 4 consecutive weeks of increases. This decline was influenced by the potential for a ceasefire deal in Gaza, which aided in easing geopolitical tensions in the Middle East. Additionally, investors were evaluating the potential disruption to U.S. energy supplies due to Tropical Storm Beryl. As of 2:34 GMT, Brent crude futures dropped by 12 cents, or 0.1%, to $86.42 per barrel, while U.S. West Texas Intermediate, WTI, crude decreased by 28 cents, or 0.3%, to $82.88 per barrel. Negotiations for a US-mediated ceasefire plan to end the 9-month-long conflict in Gaza are currently underway, with Qatar and Egypt playing key roles in the mediation process. Tony Sycamore, an analyst at IG in Sydney, noted that if the ceasefire talks yield concrete results, the geopolitical risk premium in the market could diminish. In the U.S., several ports, including Corpus Christi, Houston, Galveston, Freeport, and Texas City, were closed on Sunday in preparation for Tropical Storm Beryl. The storm, which could escalate to a Category 2 hurricane, will likely land between Galveston and Corpus Christi on Monday. The closure of these ports is anticipated to halt crude temporarily and liquefied natural gas exports, oil consignments to refineries, and motor fuel deliveries from these facilities. Warren Patterson-led ING analysts highlighted that while offshore oil and gas production might be at risk, the primary concern is the likely impact on refinery infrastructure once the storm lands. They added that any noteworthy disruptions to Texas refinery operations could support refined product cracks. Tony Sycamore from IG also stated the probability of U.S. data revealing another large weekly draw in oil inventories amid the peak driving season, supporting oil prices. West Texas Intermediate, WTI, had a strong performance last week, gaining 2.1% after an independent statistics and analysis agency, the Energy Information Administration, reported a decline in stockpiles for crude and refined products for the week ending June 28. Despite this, Sycamore noted that based on technical charts, WTI could face strong resistance between $85.50 and $87.50 after rallying 15% from its early June low. According to the weekly report by Houston-based energy technology company Baker Hughes, the number of active oil rigs in America remained unchanged at 479 last week, marking its lowest point since December 2021. Oil prices received support last week from the prospect of interest rate cuts. This optimism was fueled by U.S. data indicating easing inflation and slowing job growth, which could prompt the Federal Reserve to lower interest rates. Lower rates can stimulate economic activity and boost crude oil demand. Investors are also monitoring the potential geopolitical and energy policy impacts of recent elections in the UK, France, and Iran. France is facing a potential political deadlock after Sunday's elections, which resulted in a hung parliament. Masoud Pezeshkian, a relatively moderate candidate, won the presidency by defeating a hardliner rival in Iran.